Hello there, my name's Mark Mears, CLU. I'm president of Mears and Associates. A lot of you that are watching this short video, and we're going to try to keep it below 5 minutes or less, know me. A lot of you don't. We know that you're very good at investing. We're not here to really tell you what stocks to go in or whatever, but here's what we want you to remember. It's not what you earn, it's what you keep. So today we're going to be talking about 401k IRA taxation. Let me get right to the point. When you take the money out of your IRA or 401k, on average, the income tax rate is about 38% payable to the IRS. If you live in a state that has state income taxes, you're going to pay an additional 5 to 7%. Now let me say this, I don't practice law or accounting. These are general numbers that you need to discuss everything we're going to discuss today with your tax advisor. So let's get back to this. How can you get out of paying taxes on your IRA or your 401k when the money comes out? The answer is you cannot. So, having said that, how much will you owe on your taxes when you take your money out of your IRA or your 401k? Well, keep this in mind. However old you are today, at a very conservative projection, and this is very conservative, your IRA or 401k is going to double in value about every 15 years, hopefully more than that. So if today your projected income taxes are $250,000, 15 years from now, they're going to be $500,000. And remember, that tax is not due until the last spouse in your marriage dies. Most people do what is called an IRA rollover to their spouse, or when the last spouse dies, they do what is called an IRA rollover to their children, but the new rules say that that tax must be paid in 10 years. We've all heard about a required minimum distribution. In a required minimum distribution, it used to be 72 and a half, now it's 73 and a half. Age 73 and a half, you have to start taking out money from your IRA, or if you're retired, from your 401k. RMD, required minimum distribution. How much is your required minimum distribution? Well, let's take an example here of a person that is age 73 and a half. If they have $250,000 in their IRA, they have to take out about $10,000 a year. $750,000, they have to take out about $31,000 a year. $500,000, they have to take out about $62,000 a year. And if it's $3 million, they have to take out about $125,000 a year. I hope you have $3 million in your IRA or 401k, but remember, if you've got $1.5 million and you or your spouse live 15 more years, it's very possible that it's going to grow to this amount. Remember me saying it's not what you earn, it's what you keep. All this looks good today, but the IRS is a silent partner in your IRA or your 401k. They're licking their chops to get that 38% tax. And like we said earlier, most marriages use the IRA rollover option. That doesn't eliminate the tax, that just delays it. So for example, if you've got two 70-year-old husband and wives today and the husband dies first, usually the husband will use the IRA rollover option to the spouse. And if she lives to age 85, then the IRA will double in value. And in the meantime, she's taken out the required minimum distribution. The required minimum distribution is the magic sauce here. This is what we're going to talk about. When you take out your required minimum distribution, what do you do with that money? Most people either give it to their kids or they spend it. We think that is a bad financial mistake, and we're going to get to that here in just a second. Now, when it comes to taxes, There are three buckets. There's only three ways to get money in our financial system. One is income. That is taxable. Number two, an IRA, 401k, that is tax deferred. Not tax-free, tax deferred. And then there's the tax-free bucket. No taxes. My guess is you get very, very little money out of this bucket here. We're going to talk here in just a second how to move assets with your required minimum distribution from this bucket to this bucket. Your CPA isn't going to tell you about this because they probably don't know about it. CPAs are good. They're going to tell you how much taxes that you owe. We're going to show you how to eliminate a lot of taxes. So let's go back to the required minimum distribution. Now, let's suppose on this particular situation here that we're talking about a husband and a wife that are both 73 years old. And if you're 73 years old and you have a minimum, if you have $1 million in your IRA, your required minimum distribution is estimated about $40,000 a year. Think of this. This is called second to die life insurance. Some people call it survivorship life insurance. You're already having to take out $40,000 a year if you're both 73. Look at this concept. What if you used about $25,000 of that required minimum distribution? That's where this almost $25,000 a year is coming from, to purchase a $1 million second to die life insurance policy. Now that may take a minute to sink in because this is an unusual concept. Remember, the tax isn't due till the last spouse dies. So what this does, it insures a husband and wife for a $1 million life insurance policy, and it doesn't pay until the last spouse dies. It's perfect timing because that's when the tax is due. So if you're getting a $40,000 required minimum distribution, we're saying consider this concept. Buy a $1 million policy, life insurance policy, with about $25,000 of your required minimum distribution. And then when you die, when the tax is due, let's say you have $1 million in your IRA, and let's just assume the tax on that is about $400,000. This RMD is going to fund a $1 million death benefit. Not only will that pay the tax due, it's going to leave an extra $600,000. Now, how much of this $1 million on this second to die policy is taxable? Remember, your RMD or your 401k IRA, when it eventually is taxable, it's all taxable. This $1 million is 100% income tax free. No taxes, none. All paid in cash. If the policy is set up correctly, it's not subject to income taxes. It is not subject to estate taxes. You are using your RMD to create this $1 million tax-free death benefit to pay the tax. Instead of losing 40%, this is going to double what your children or grandchildren inherit. This is illustration number 1. Okay, let's look at another concept here. Here's a 71-year-old husband and a 71-year-old wife. Now, I'm assuming this 77-year-old husband, this is illustration number 2, I'm assuming he's got about $1.3 million in his IRA. $1.3 million means he's got to take out about $52,000 a year. $52,000 a year funds a $2 million death benefit. Do the math. Not only will this tax-free death benefit pay all the tax, a lot will be left over. Remember, this death benefit is paid when the last spouse dies. Don't need to spend a lot of time on that because we already talked about the other ones. I think you understand the concept now. This is illustration number 3. This is two 75-year-olds that have about an RMD of about $28,000 a year. $28,000 a year on two 75-year-olds will fund a $750,000 tax-free life insurance second to die policy. I mean, do the math. In 20 years, you've paid a total of $553,000 in premium if you live to 95, and you get a death benefit of $750,000 tax-free. That's very strong leverage. That was illustration number 3. Illustration number 4. Now this concept's a little different. This is two 68-year-olds. They currently don't owe any RMD because they're not yet at 73 and a half. But what if they wanted to get ahead of the game and take out about $18,000 a year from their IRA 401k now? That would purchase, this is illustration number 4, $1 million death benefit. If they live 20 more years, they've paid $270,000. If they live 15 years. If they live 20 more years, they paid $361,000, and they have this $1 million tax-free death benefit. Now, when you get in older ages, the tax that's payable to the IRS, it doesn't mainly affect your children. Most of the time, it affects the grandchildren. Your children by this age are usually grown on their own. Heck with them, they've made it. We've invested a lot of money in them. We're now more concerned about the grandchildren. And this last illustration, this is illustration number 5. This is the same two 68-year-olds. They're eventually going to have to take out $50,000 from their IRA or 401k on the required minimum distribution the government's going to make you. If you start taking out about $50,000 now, you can get a $3 million second to die income tax-free death benefit. So, having said that, the IRA 401k is going to be subject to about a 38% income tax. Now I want to ask you a question. Today in 2023, do you think that 20 years from now, income tax rates are going to be higher, or do you think they're going to be lower? Most people are going to tell you that income tax rates are going to be going up. Why not take about 1% of your IRA 401k every year, fund a second to die policy, and have 100% income tax free, no taxes, none, death benefit, because the tax isn't due until the last spouse dies. This is perfect timing. The second to die policy pays the tax, and there's everything that's left over is then passed to your children, grandchildren, spouse, whoever, with zero income taxes. My name is Mark Mears, CLU, President of Mears and Associates, and we specialize not just on helping people to accumulate money, but how to pass it in the most tax favorable way to the next generation. Because remember, it is not what you earn, it is what you keep. I hope you call me at my number today. Thank you.